the interest rate gap that could end America's financial reign. For nearly 80 years, the United States dollar has been the bedrock of the global financial system. Washington could borrow cheaply, spend lavishly, and finance not only its own growth, but also the rebuilding of war-torn nations, the race to the moon, and the highways that crisscross the continent. Cheap capital was America's superpower, a hidden force that gave it unmatched influence over trade, investment, and innovation. But something is happening right now that threatens to rip that advantage away. The cost for the U.S. to borrow money, the interest rate it must pay buyers of its bonds, has surged to levels it hasn't seen in modern history. And worse, it's now higher than the borrowing costs of nations Washington once viewed as financially unstable. One of those nations is America's biggest strategic rival, China. Today, Beijing can borrow for 10 years at just 1.7%. The U.S., by comparison, is paying 4.28%, more than double. That's not a temporary market quirk. It's part of a widening gap in global financing costs that could redefine who holds the economic high ground. This isn't about obscure bond market charts tucked into the back of an economics textbook. This is about who gets to write the rules of world trade, who controls the flow of global investment, who can build the roads, ports, and data centers of the future, and who can't afford to because in the modern world, access to cheap capital is power. China's falling rates, America's rising burden. Look across the Pacific, and you'll see a completely different picture. In China, borrowing costs are falling across the board. 2-year bonds? Down. 10-year bonds? Down. Even 30-year bonds, the ultimate long-term bet, are cheaper than they've been in years. Inflation? Barely noticeable. Consumer prices are stable. In some sectors, they're even falling thanks to a surge in factory productivity and supply chain efficiency. Exports are outperforming forecasts. Factories are humming. And Beijing's government can tap global capital at interest rates the U.S. hasn't enjoyed in decades. Meanwhile, in Washington, the situation is reversed. Borrowing costs are stuck near their highest sustained levels in modern times. Inflation is still uncomfortably high, and tariffs are pushing producer prices up even further. Foreign demand for U.S. debt, once the envy of the world, is drying up. Nations that used to finance America's deficits aren't just buying less. They're selling off the treasuries they already own. At the same time, China and its BRICS partners are constructing an alternative financial system, one that might not need the U.S. at its center at all. Cheaper loans from Beijing than from Washington. One of the most shocking statistics buried in recent financial reports comes from an unlikely place, China's Belt and Road Initiative. Despite criticism of the program's geopolitical aims, the numbers tell a stunning story. Chinese overseas loans carry an average interest rate of 4.2%. That means a government in Africa or South America can borrow U.S. dollars from a Chinese state bank at lower rates than the U.S. government can borrow those same dollars from its own investors. That is not how the system was supposed to work. America's short-term gamble. When Treasury Secretary Scott Bessent took office, he was already alarmed by how high rates had climbed. His strategy? Avoid locking in long-term debt at today's expensive rates. Instead, the U.S. has shifted toward selling short-term Treasury bills that mature in months, not years. The hope is that the Federal Reserve will cut rates soon, making long-term borrowing cheaper later. President Trump supports the move. In the short run, it lowers interest costs on new debt. But there's a massive flaw in this gamble. Actually, two. First, the scale of U.S. borrowing is staggering. Washington needs to raise about $2 trillion every year just to cover the deficit. That sheer demand for cash forces investors to demand higher yields, no matter what the Fed does. Second, The Fed's power over long-term rates is far weaker than most people think. When the central bank cuts its overnight lending rate, it barely nudges mortgage rates or the 10-year Treasury yield. Those longer-term rates are driven by global investor demand, and that demand is faltering. The $10 trillion year. Here's the real nightmare. Over the next 12 months, $9.2 trillion in existing U.S. debt will mature. It was issued years ago at far lower interest rates. Rolling it over now will cost vastly more in annual interest payments. Add in roughly $1.9 trillion in new borrowing, and Washington must sell over $10 trillion in debt in a single year. That's more relative to GDP than it costs to fight World War II and rebuild Europe under the Marshall Plan. But unlike in the 1940s, this isn't funding grand national projects. It's just keeping the lights on and paying old bills. The danger is compounding. Each time cheap debt matures, it's replaced with expensive debt. Over time, interest payments snowball, squeezing out spending on infrastructure, defense, and innovation. A market losing patience. Strain is already visible in U.S. debt auctions, the regular events where the Treasury sells new bonds to investors. From August 6th to 8th, 3 major auctions sent warning flares. August 6th, a sale of 3-year notes saw the weakest foreign demand since 2023. The auction tailed, meaning yields had to rise to lure in reluctant buyers. August 7th, a $42 billion auction of 10-year notes also tailed, with foreign demand dropping again. August 8th, the worst result yet, a $25 billion sale of 30-year bonds with foreign interest at its second lowest level in 5 years. Yields jumped across the board. The message was clear. Foreign buyers, especially large institutional investors and central banks, are losing interest in financing America's debt. China steps back and builds elsewhere. This isn't just about market mood. It's about deliberate strategy. China, once a top holder of U.S. Treasuries, has been cutting back for years. Beijing's reserves are being funneled into gold, domestic banking liquidity, and most importantly, infrastructure projects in nations aligned with China's long-term interests. Treasury holdings are now at their lowest point in over 16 years. And other foreign buyers are starting to follow suit. Instead of lending to Washington, Chinese banks are financing railroads in Africa, ports in Southeast Asia, and energy projects in South America, often at rates far below what the U.S. government or an American family could get at home. The steeper curve that hurts everyone else, even if the Fed does cut rates soon. It's likely to steepen the yield curve, lowering short-term borrowing costs but leaving long-term rates high. That's a short-term political win for the Treasury, which is now leaning heavily on short-term debt. But it's bad news for everyone else. Businesses looking to finance expansion, homebuyers seeking mortgages, local governments trying to fund schools or roads. For them, borrowing costs would remain painfully high. Why cheap capital decides. Who wins access to low-cost financing is the foundation of economic power. It fuels consumer spending, business growth, and innovation. It builds infrastructure that attracts more investment. For decades, the U.S. could borrow cheaper than almost anyone. That meant it could out-invest rivals, outbuild them, and out-innovate. Then. Now, China and its allies are flipping that equation. In much of the developing world, governments, companies, and households can borrow money, often in U.S. dollars, at rates less than half what Americans pay. The geopolitical consequences are huge. The nation that can finance growth more cheaply can set the pace of development, dictate trade terms, and draw other countries into its orbit. A shift in the center of gravity. Happening isn't a temporary market hiccup. It's a structural shift in global finance. The U.S. is trapped in a cycle. Roll over trillions in old debt at higher rates. issue trillions more to cover deficits, and hope the market keeps absorbing it. China, meanwhile, is leveraging its lower borrowing costs to expand influence abroad. If the trajectory continues, Washington's ability to set the rules of global trade and finance will erode, perhaps permanently. The center of gravity in the world economy is already shifting eastward. For now,